In this video, guys, we're going to look at how to stop letting emotions rule your investment decisions. Stay tuned. Hey traders, I'm really one for investors, but I know a lot of traders out there also have portfolios of stocks. I want to look in this video about how you stop letting your emotions rule your investment decision making process. Now, we know in trading, very, very crucial to kind of keep an eye on those emotions. We don't want to swing one way or the other. Don't want to be too really excited about things and greedy. We don't want to be too fearful. We have to have that sweet spot. And exactly the same in investing. I could argue that it's a little bit easier in investing, and you probably have those investors who are watching this going, no, it's not. But my argument is this: it's slightly easier in investing because it's not a continual process. In trading, because you're trading more frequently, or you're transacting more frequently, should I say, you kind of have a situation where your emotions can swing quite wildly, quite quickly. You guys know, if you're day traders, or if you know a day trader, or even a swing trader, to be honest, an active swing trader, you can be really sad one day and then really happy the next, and you've got to kind of dampen that down. Anyway, back to the point of the video. This is not a competition between traders versus investors. Point is, emotional control is very, very useful whatever we're doing. In this context, looking at it in the aspect of investing and running a portfolio or managing a portfolio for yourself. Okay, so we've got two different columns here. We've got enhance and dampen, because I genuinely believe emotions are useful if you know how to harness them. We'll look at that in a second. Let's have a look at dampen. So dampen means we want to kind of limit the potential damage that emotions can do to our investment decision-making process. So the number one thing, same with trading, guys, is to write down a plan. You know, decide how you're going to invest. Just like you would do if you were trading, write down your setups. How are you going to invest? What are the fundamental criteria, perhaps? What other criteria? Do you have some sort of news criteria, some sort of earnings criteria, some sort of market cap criteria? I could go on, but you get the idea. The idea is, hey, these are my criteria, just like Warren Buffett has a criteria. He says, you know, great companies that are great, making great amounts of money and good money and have been in business a long time, but are good value. Very, very simple. You may have a similar thing. We may have a different thesis. Your thesis might be, you know, stocks that are very low priced but have a high chance of doing 10 times in a year, and I'm going to spread my risk over those. So the point is, if you know what your plan is, you can reduce a lot of the emotion, because it reduces the filtering time, it reduces the search time, and ultimately ideas are kind of brought to you and you can just execute them based on your plan. You're taking out a lot of the decision making process in your mind. Do your research. So this will stop you getting caught out in something like, let's say, for example, you putting your net worth into stocks at the market high, and you don't kind of do your research and say, well, actually, this has been running on for 25 years, whatever it may be. I may have to sit through a bit of a downturn here. Can I stomach that? So it's not necessarily changing your thesis. It's saying being prepared for what might happen. If you're in a bear market, for example, you start buying stocks in a bear market, history might say that actually, you know what, these bear markets go a lot deeper than you believe or you expect. So can you stomach that risk, or is that going to change your plan? So looking back in time, specifically for investing, a little bit easier to do that from an investing perspective. You know, how has the market behaved under these conditions before? It's not to say it's going to do that again in the future. If it did and it was predictable like that, we'd all have billions and billions of dollars and pounds, but it doesn't. So we can only use it as a guide. But the point is, you don't want to get caught out by something that possibly could happen. Don't watch your portfolio. Massive on this. You know, if you're a subscriber to the channel, by the way, appreciate it. If you are, thank you very much. You know, if you're watching your P&L on a trading perspective, up, down all day, it can drive you nuts. And you know that if you're watching the videos, I'm a big advocate of taking the P&L off the screen. You shouldn't be watching your P&L intraday. Same as you're investing. Don't constantly watch your portfolio. You know what your portfolio is. You know what you're long, which stocks you're long. Potentially, if you're short, I guess investment, you wouldn't be, probably be long an inverse ETF if you were short. But regardless, your positions, you know what your positions are. You don't need to keep logging into your brokerage account and checking the value. It's irrelevant. You've got a plan for entry. You've got a plan to exit. You don't need to check it, or at the very least reduce the amount of time you check it. You don't need to log in every day. You can log in once a fill in the blank that suits you for your investment criteria and how long you're investing for. That'll help you loads. It helps traders loads, and it'll help investors. So, and if it really gets to you, you really kind of think that, hey, you know what, I'm quite good at picking stock, but I'm rushing out of things, I'm letting my emotions take control. Consider external portfolio management, whether that is a professional, which is the obvious kind of thing that you would take from this. Hey, it's professional, give it to a professional and pay the fees to do that. Of course, that's the downside with it. Or pay somebody you trust, maybe a family member, a close family member, to help you manage this portfolio. Say, listen, sit down, have a chat and say, listen, I'm good at picking stocks. I'm good at picking companies that are undervalued, whatever it may be, but I struggle in taking profits too soon. I struggle with little dips. I struggle with whatever that struggle may be. Talk to them and work out a plan of how you can both combat that and then compensate them for helping you, because you're going to make way more money. So it's something to consider, recognizing weak spots, and that's something that obviously all good leaders do anyway. Recognize their weak spots and bring in people to fill in those gaps. So you can do that yourself if you're a portfolio manager for your own stocks or for your own assets. Right, enhance. How can we enhance our emotions? How can we use them as a tool to benefit us? So the obvious one, which I haven't got on here, is gut feel. Now, if you don't like an investment, something doesn't sit quite right with the criteria, listen to the gut. There will always be something else round the corner. I'm a big advocate of trusting it when you're in a position to give it the trust. So if you've been investing for a while, you'll know. If you're a new investor, maybe not. Maybe just go ahead and trade small, invest small. But listen to your emotions, because they're often quite accurate. Okay, but back to the other 2 points I've got on here. First one, use emotions to predefine risk. So this is a really, really good one. How do you do it? So you basically say, you know what, how much am I prepared to risk on this deal? How much am I prepared to risk on this investment or in this stock? And the way you do that is you say, how would I feel if it went down 30% next week? You're not going to be happy, but would you feel so much pain that you would want to cut the stock? If so, potentially you want to reduce your size, because perhaps you might have to sit through that if you believe this investment. Obviously, it depends on your the kind of the cycle you're looking for a 20-year move, a 10-year move, 15-year move, or 2-year move. It's going to depend, but you're using your emotions to say, well, actually, I wouldn't be comfortable losing 50% of my money in this stock, so I need to dial down the position size to something a little bit smaller, and that's something you can look at. Okay, last one here, guys, taking notice of emotions during drawdowns. This will help guide you to this. How do I feel in a drawdown? Might just be a pullback, might just be something that's completely meaningless, but how is it making me feel? Is it making me feel nervous? Is it making me feel concerned, feel happy? Take stock of that, and then you can go back and adjust and write down into your trading plan, which will contain stuff like the risk and what you're going to do and stuff. So anyway, guys, that is how to stop letting emotions rule your investments. If you've got any more, add them in the comment section below. Otherwise, take care. Good investing. I'll see you in the next one. Bye-bye.